So now we're going to part number 2, which is the distribution. We've already spoken about the protection part of it, and now we're talking about the distribution, the trust fund. So I'm going to talk about it now from the financial point of view. Winnie will take you through now the legal structure of the trust fund. This is now to more or less show you how it is that you can start it, where it is that you're at, because most people feel so overwhelmed and feel like it's such a lot of money to get started when it comes to now thinking about distribution of now your assets, but I want to show you how it is that you can get started now. So things that you might ask yourself, okay, what if I'm not, like, what tool can I use if I'm not comfortable with the guardian receiving a lump sum? Because remember, with a life cover, if you've taken, say, a 10 million shilling cover and you've left it to the guardian, it will be in the guardian's account. Sometimes maybe you're not very comfortable that the guardian will receive the whole 10 million. You want to have a bit of a say of maybe how much the guardian will receive a month instead of them receiving the whole thing cash, because you don't know whether they know how to manage the money or, if they'll actually spend the money on your child, right? Number 2, you have cash in the bank, and if you're to pass away or get incapacitated, will your dependents access it with ease? Yeah, because another thing we see a lot, especially when it comes to now family courts during succession, many people have family members or parents who had money, but they cannot access that money. So how is it that now you can plan accordingly to ensure that in the case something was to happen to you, your family can still receive these funds easily? And then are there any other ways that I can save up for my kids' education? Maybe a flexible way other than, say, education policies to make sure that funds do not go through probate. So this is where trust funds come in, right? So a simple trust fund. So first of all, a trust is going to be compared to a safety deposit box that holds valuable items for the benefit of your loved ones. So for this trust fund, the simple trust fund, it's going to hold only cash. Remember, we're talking about now for, in this specific instance, we're talking about the trust fund, the one that holds cash. Winnie will talk about now the whole trust fund as a whole, yeah? So what is a simple trust fund? So the fund is held in a secure investment kitty that preserves capital. It literally works like just a money market, only that it has the extra layer of legal protection. So when it comes to how the money grows within this kitty, it still grows with a return of about 8 to 12% per annum, every compounded, because the money it is that is going to be put in this kitty is going to be actually invested in something now like a money market. The only thing, as I said, is that now there's the extra legal protection, yeah, because you see now with the money market, say if someone was to pass away today, because there's some money markets which actually say, oh, put down your beneficiary, but there's no proper rules and regulation yet in paper, which we will talk about, that in the case now someone was to pass away, that the money from your money market will go directly to your beneficiaries. It's a maybe. So usually if you want to get rid of that maybe, you can put it now in a structure where you are assured that in the case you're to pass away or get incapacitated, this money will go to your dependents. So the contribution is flexible, just like a money market, right? You can, but usually maybe for discipline purposes, you can choose to put this amount of money, say every month or every quarter, to be able to reach your goal. The minimum amount to start is 5,000 shillings to just set up this simple trust fund, to be able to get a trust fund account for your child. So how do you fund your trust? So you can continue contributing, cash regularly into the account, just as I said, just like a money market or any other investment account. And then also life insurance proceeds can be used to fund this trust. So in the case now you have a life cover, like let's say at that time, Mary has the 10 million shilling cover. If she was to pass away, instead of it going directly to a person, it can get into the trust and then to be distributed according to her wishes. So that means that instead of making her child a beneficiary, she makes the trust the beneficiary, the legal entity that can be able to receive the funds. Because remember, trust is like a person in this case, right? It receives this money. But you see, when it comes to now structuring the trust, which one is going to take us through, you've already written who it is that you want to benefit and who it is are going to be the guardians, right? And another way to fund the trust is now pension plan proceeds, both personal and group pension, to make the trust fund a beneficiary. So let's just repeat here. So remember, this is like a kitty. Just think of it like a pot of cash, right? So for you to be able to fund this trust fund, it's just like it's an account, literally, just now with the legal protection, right? So you keep on now putting that money every so monthly, every quarterly, or when you have a lump sum, anytime you have money, you put in money there. And now in the case now, you're like, okay, me, I don't want anybody to touch my money. I would want this money to now go somewhere where I can say, instead of someone receiving 10 million, they can receive maybe 50,000 a month to take care of my kids. And then at the end, my children will receive whatever is remaining. Yeah, that's this structure, and this tool can be able to help with that. So the life insurance proceeds and pension proceeds can be now used to fund the trust. So what that means is you make the trust the beneficiary of the pension or the life insurance. So if pension, you had put your spouse or your kids, instead of now putting your spouse or kids, you put the trust fund. So simple uses of trust fund. It can be used as startup capital for your kids to take care of their business. Because remember, this is cash that you put in there. Then you give reason why it is that you've put there, and then your children will be able to access it when the time comes. And it can also be used to fund education, or even, home deposits, a house deposit for your kids. Because we said what? We're going to be a stepping stone and not a stumbling block. So if there's any way that you can pay it forward, I would advise for us to do it. So I want us to do some projections. So let's look at the child on the left and the child on the right? So let's say, as I said, Tony and Mary, right? So if this person was to contribute monthly 5,000 shillings for the next 20 years, by the time it's year 20, right? Because remember, this means that they're contributing every single month. Even if they skip a month, it's not going to affect them. The only thing that will be affected is the maybe final return. But because now, remember, it's very flexible how much it is that you can be contributing and how often it is you can contribute. But you see, at the end of the day, after those 20 years, the amount of money that will have been accumulated is 4.9 million. Can you imagine what this boy can do with that 4.9 million? They can use it for maybe to further their studies. They can use it for a business. They can use it maybe as money to go get married and maybe for a wedding. It's now dependent on how it is that you choose how the money is going to be spent. And now let's look at the projection of the person who's on the right, Mary. If their parent was contributing about, actually this is meant to be 10,000 shillings for the next 20 years at an interest of 12%, it means that at year 20, there's 9.8 million shillings for this child. Isn't that a good deal, honestly? Isn't that a good thing? And you see, nobody can be able to access this fund in any way except how it is that you have written and structured it in now when you're applying for the trust, which I'm going to show you practically so that now you can have an idea of how you go about it. Yeah. So how do you set up a trust fund? So first of all, you have to give instruction via a legal document, which in this case, it's a grant letter to create the trust fund, and then now eventually start funding the trust. So I'll show you an example of that. So how does the application process look like? Because just think about it this way. Basically, you're opening an account within a trust. There's already an existing trust. So what it is that you're opening an account within that trust, and you are benefiting from the legal protection within that trust. So first of all, you fill in an application form and you send your requirements. So that means your ID and your KRA PIN for yourself and also for the guardian. And then you also now send in the beneficiary birth certificate or ID, because remember, the beneficiary is the one who is going to be receiving this money, right? And also at the point maybe the beneficiary grows up and is of age. And then you send also now the proof of payment. There's usually like a pay bill number, or you can even transfer it directly into an account. And then you are going to receive what we call a grant letter, which Winnie is going to explain to us what exactly that is. And then when you sign it, the trust account is open and you can start funding it. You can start sending in money every month, every quarter, depending on your needs or your capability. And then eventually what you could do, if you already have existing life cover and pension, you can change the beneficiary to the trust fund, right? So before we go into pension plan, I'd like maybe to show you how exactly this application form looks like. So you can just have an idea. And then I don't know if you can see my screen.
Yes, we can see the form.
Okay, yeah. So if Winnie, are you there? So Winnie will help us also when it comes to this as well. So Winnie, hello. Hi, Winnie.
Hi, how are you?
I'm good. How are you?
Mm-hmm.
So I want to take people through this application form so they see that it's not as complicated and it's pretty easy to set up. So
Yes.
I know that you're going to explain to us like things like settler and beneficiary, guardians, and all those things, but let the people understand how this
Okay.
one looks like, right? So you can see
Okay.
here, settler is the person. So I'm going to talk based on my experience and how it is that I filled in this form because I also have it to take care of my children's education. So settler is me, the person who's now creating this. So obviously now put in my details there. And if it's a joint one, it means that you put for you and whoever it is that you're doing it with, right? So maybe you and your spouse, you and your siblings, it depends on what exactly the trust is for, the trust fund is for, and what exactly how you've decided you're going to you're going to structure it. And then an institution can also own the trust fund. Say you have a company, and you want to now be putting your money within the trust fund, you can also, open one. So you can see here, companies, charities, churches, school, you can put money in here. And then if it's an institution, obviously now there's the signatures that they have to put in there. But let's just see, like, if it was us as individuals, this part will not be relevant to us. Then there's the purpose of the trust. This is where now you say, do you want it for education? Do you want to now save up money maybe for Medicare, for upkeep, or any other? Say you want startup capital for your kids, you'll put it there. So if it's for upkeep and you're putting this money so that it can be able to take care of someone over a period of time, you can say, how often do you want this money to be disbursed? Say, for example, there's someone who's taking care of your child and you want that person to have money for upkeep. You can say, okay, I want this money to be given to this person every single month or every single quarter, depending on how you've structured it. And then there's the payout bank details, where exactly this money is going to be going in the case of upkeep. And remember, a trust, the trust fund, you can still use it when you're still alive, right? And then here, preferred age that trustees should hand over all outstanding funds to the beneficiary. So say, for example, a life insurance proceed was paid here, and that amount is used to take care or upkeep for the kids, the education of the kids. And then eventually your kids are now in their 20s, they no longer need that money, maybe at that time for upkeep. So you can actually say at what point you want your beneficiaries, at what age for them to receive this money. You can say 23, 25, 18, it's up to you. So source of funds. So initial investment, this is where now we told you, like, you start with now the first 5,000, but now when you're topping up, you can top up with whichever amount, but to start is as 5,000. So you can say, okay, salary or savings can come from your salary, sale of an investment. Let's say you sold a piece of land and you have lots of cash. You can just put the money here as a lump sum. Retirement benefits. If you got a lump sum as well, you can put them here in the trust. Donation, inheritance. Yeah, you can just now say exactly where your monies come from. So if the source is not written here, you can put it, you can just like specify in this part. Then this is where the beneficiaries come in, the people who are going to be benefiting from this cash. So that could be your children, could be your parents, whoever it is that you want to benefit from this. If it was, say, Medicare or upkeep for the parents, you can even put the parents here. If it's now upkeep for the kids or education for the kids, you can put the kids here. It's, as I said, literally up to you and why you created this trust. Yeah. And then, yeah, that's it. For the beneficiary here is now for institutional. So we're going to skip that part. And then guardian. So here there's now principal guardians, the people it is that you choose to be able to manage this, to be receiving this money. In the case now, for your children, say, for example, if you are not there, so you can choose even two guardians. Say, for example, you want a bit of accountability, you can pick two guardians, right? And in the case something was to happen to the initial guardians, you can pick successor or alternate guardians, right? So you have at least quite a bit of flexibility in that part, right? And then, yeah, then here you just sign. Signing arrangement for the individual settlers. So if it was just you, you can just sign. If it was the two of you jointly, both of you sign. So the people here, anyone here listed, yeah. So for me, I just signed by myself because I created it by myself, right? And that's about it. Then after that, now I just put here my residential details and then a witness. And I send this plus all the details. And my trust fund is going to be up and running for my kids. Yeah. So at this point, when this document has been sent out, you're going to receive something like this. Yeah, I hope it is clear, but in the case of anything, you can just always ask us any questions. But let me just share how the grant letter looks like. Yeah, it looks something like this, right? So it's more or less just summarizing what it is that you've put in the application form, right? So you're going to say, okay, this is where it is that you live, the source of funds, it's for medical, educational upkeep, whatever it is. And then eventually, okay, we don't mind sending this for you to go through it. And then you just have to sign and send it back to now the company. And then after that, now you're going to have a trust fund. It takes about 5 to 7 working days to set this up. And then after that, you can continue funding. Because remember, over here, you'd already have sent the first amount to just open the account, and the amount will start growing, yeah, over the period of time. And you can have access to the statements, and you can be able now to see how your money is growing over time. And as I said, you can do it monthly, or if you have a lump sum, like let's say for someone like me who's in business, I don't maybe put money monthly. If I have a lump sum, I can send it there for my kids. Yeah, because for me, the one which I've opened is for their education, because my kids are 3 and 4 right now, and I'm looking to them going, and I'm saving for their university education. So eventually I want now the money to be able to be received at that period of time. So right now we're open to taking questions, Winnie and I, in the case of any questions. I don't know if there's any questions.
There's quite a number.
Yeah.
So I'm going quite a bit. The trust conversation is pretty exciting in the Q&A section. So there's someone who's asking, do I need to write a will then once I establish a trust fund? Like if someone has a trust fund, is it a must for them to go ahead and also write a will?
Winnie can answer that question.
Yeah. No, you don't need to write a will over your trust fund, but you still need to write a will generally. Yes, because it is the assumption I'm making that you have other things that you cannot place in the trust fund. Remember, what Nyindo has shown you is a cash trust fund. Yeah.
Yeah. Yeah,
Okay. Now that you've mentioned cash transfer and Winnie, I'm gonna come back to you. Bimusomi in the Q&A section is asking, can one then have a trust fund for real estate property and not necessarily for cash purposes? So what happens to the non-cash? Briefly, I know you're going to probably be covering that, but
Yes.
what happens to non-cash purposes, non-cash investments?
Okay, so allow me to differentiate between trusts and trust funds. And I'll say trust fund because the fund is automatically assumed to be simply cash, a liquid trust fund. So either you're putting actual money, depositing it into the account, or you're sending payouts that will be received in liquid funds. A trust, on the other side, will be for real estate property, not necessarily only real estate or just houses and apartments, but for any other property that you would like to place under trust. To avoid the probate route, then you'd have to create an actual trust. So the trust fund here, what Nyindo is showing us, is an already established trust, but can only receive liquid trust funds. When you need it to receive a real estate, now you'll have to create a separate trust over such real estate property.
All right, thank you. I've seen a lot of the questions that we have here with regard to the trusts are probably going to be answered in the session that Winnie is about to take us through. So because most of it is mostly like in terms of how can you incorporate other investments and also and what also happens when, let's say, beneficiaries die, or even like one of the people you've put as a trustee dies. Yeah. So maybe the other thing There's Wangari in the comment section asking, for both life insurance and trust funds, are the funds held taxable at any point in time? I think that's a very important question to answer in terms of like tax either benefits or liabilities.
So is she talking about the life insurance proceeds?
Yeah, she's just written for both life insurance and trust.
Yeah, sorry for that. Please repeat that, Susan.
Seeing the question here, she's asking, for both life insurance and trust funds, are the funds held taxable at any point in time?
So when it comes to life insurance proceeds, those ones are not usually taxed. Just generally, when it comes to, so when someone passes away and life insurance payout is made, whatever was written as the sum assured there is what is going to be received. So that amount of money is not usually taxed. And now regarding the taxation, when it comes to trusts, Winnie will cover that.
Okay, so trust funds don't usually get taxed, although that's not like fully correct. Trust funds receive tax liabilities depending on where they have been invested. So the trust fund in itself is not taxed as an individual or as an individual account. A trust fund invested in a particular asset, if it invests in infrastructure bonds and the bonds are tax-free, then the trust fund, the cash in the trust does not get taxed. The trust fund, if it invests in shares and what you're paid back is dividends, then the withholding tax is a tax that it will pay to receive those dividends. So the structuring of a trust in a trust fund based on tax efficiency now will depend on where you're navigating the trust fund into and what kind of investments you want it to play.
All right. So I think that part on taxes we've handled. Nindo, you can continue with the next segment. The rest of the questions, we will cover them as Winnie takes us through the legal aspect of the trusts.
Okay,
And the trust fund.